Happy Friday, everybody. Welcome back for another segment, our final segment of entity structures. So far we've talked about single member LLCs and sole proprietorships. We've talked about S corporations. We've talked about partnerships flowing into S corporations. And so finally, we are going to talk about your traditional corporation. So, uh, uh, people tend to call these different things. A C corporation for tax purposes, a traditional corporation, a large corporation. Sometimes they're misnomenclatures. So a lot of people think S and S corporation stands for small corporation, and so then we have a large corporation. That's not necessarily true. It actually stands for subchapter S of the Internal Revenue Code, and then you just have a regular corporation. You can be any size to be a regular corporation. There is no limitation on registering or incorporating in your state. So by default, to be a traditional corporation, you have to incorporate in the state that you're headquarters in for your business. You can also get there for tax purposes by registering an LLC and then electing to be taxed as a traditional corporation instead of an S corporation or partnership. Um, but a traditional corporation, why would you want to be one? Typically, it's because you're going to have silent investors, not necessarily partners helping you run it or friends and family contributing to help you start a business. This is more like you're getting completely unrelated outside investors coming to be a part of your company, and they are literally only being investors. They're going to want to buy stock, and so their risk is limited to the value that they contribute, and that's it. So it's very, very difficult to sue limited shareholders who are just stockholders in a company. So and like in a default on if you're going in bankruptcy or default on a loan, it's very, very, very difficult for anybody to go after regular stockholders. Um, so that's typically the number one reason why you would be in a regular corporation. A lot of people ask me, "Hey, Jason, where should I register my business?" And a lot of people have heard that Delaware or Wyoming are phenomenal places to register your LLC or your business. Um, my biggest response to that is why, as a small business, you are already going to owe taxes in whatever state you're living and operating your business in anyway. Why register in another state to duplicate administrative burden? If you're going to be a traditional corporation, now there is a reason beyond that. So traditional corporations, I would recommend to be registered in Wyoming or Delaware because the state statutes and laws surrounding corporations in those states are favorable to the shareholders, which is why typically angel investors and shareholders like to see corporations and investing corporations that are registered in those two states. Um, that's about the only reason why I would say to register in a state you don't live in, is if you are looking for outside investors. The other nice thing about a traditional corporation is you can actually sell different types of stock. You can structure partnerships similar to this to have different payouts and different things going on. That's the benefit and flexibility of a partnership. Um, but a corporation can have what's called preferred stock. It can have different levels of stock. It can have your common stock. Basically, the sky's the limit there. So when you talk about preferred stock, it has this term preferred, and so we think it means that you want that stock. Um, it's It's more of an idea that preferred stock basically means you can treat it however you want to, as long as it's people know what they're buying. For example, it could actually be considered more like a debt. So somebody buys preferred stock, and it just means that basically they're going to get paid back their investment plus some interest over time. It could be an actual preferable payout to certain type of stockholders, kind of an incentive plan for corporate executives. But basically, the sky's the limit. If you want to create a special type of stock to incentivize somebody to do something or to invest in your company, a traditional corporation has the ability to create a preferred stock in addition to common stock. Common stock would be your traditional owners. So in a partnership, it's the partners. The common stock in a single member LLC that's taxed as an S corporation is the single member, but in a traditional corporation, it's the common stock is owned by the majority owners in the company. They're the ones that would create the board of directors. They're the ones that would have more say in how dividends are paid out after preferred stock, if that's how those are structured, different things like that. So that's kind of the benefit to a traditional corporation is it does allow more flexibility in types of payouts to owners, and it allows for more protection to the investors themselves as they contribute or buy stock in the company. It is also easier to sell a traditional corporation because you can just do, here's my stock, here's what I purchased it at, and now I can sell it. There's not always a marketplace to sell stock like that. Privately owned companies can be difficult to buy and sell stock. Publicly owned companies means they're traded on a public stock exchange like the NASDAQ or some of the others, and you can buy and sell stock on these, and we all hopefully know what that means. Now, the downsides to a traditional corporation. Basically, when it really comes to it, the biggest downside is what we call double taxation. So the traditional idea in double taxation is that the corporation produces a profit and they're going to owe income taxes on that profit. So for example, let's say you're a shareholder in Microsoft and Microsoft makes $1 million profit. So they're going to owe income taxes at the federal level on that $1 million profit. They're going to say, great, we just made $1 million profit. We paid our $700 or $300,000 in taxes, and now we have $700,000 left over. We're going to take $500,000 of that and put it in the bank for future operation expenses. And then we're going to say, okay, we decided as a board of directors that we're now going to issue a dividend of $200,000 over all the shareholders. That would be like pennies, really, but so let's say you're one of those shareholders, and just for ease of math, let's say there's only like 20 shareholders. So 200,000 divided by 20, you're going to get something like a $10,000 dividend. That was probably horrible math. But anyway, let's say you get this $10,000 dividend, and now you're going to owe income tax on that dividend. And so this same cash has now been taxed twice. It got taxed as corporate income tax, and then it got taxed as dividend income to you at the individual level. So we have this double taxation. Well, this happens with pretty much any money that comes out of a corporation. You are subject to tax rules for any money that you take out of a corporation. So your cash kind of gets locked in this corporation unless you're willing to pay additional taxes on it. For example, if you are the only shareholder and the CEO of this company, you're required to take wages, just like in a regular S corporation. And so you're going to take your reasonable and fair wages. Well, those wages are going to be subject to Medicare and Social Security and income taxes in order to pull that cash out of that company. Another option would be like a home office deduction. Let's say you want to work from home, so you're going to rent some office space to this corporation. So you get rent income coming out of that corporation. Well, now you have to put it in a rental schedule. You can show some rental expenses on it, but ultimately you now have rental income you're reporting and you're going to owe some income tax on. If you take dividends, there are some special rules when it comes to small business dividends or long-term ownership of a company, so some preferential statuses. But for the face value, you're going to owe income tax on those dividends. The third way that, or one of the other ways that you can take money out of a regular corporation is a shareholder loan. So basically, you loan yourself money out of this corporation. Well, now that is a debt that you owe to this corporation, because even if you're the 100% shareholder in this corporation, you are still liable to this corporation for that debt, especially if there's a legal action brought to your company, or if you want to sell your company, or if there's other issues that arise. So you now owe money to this corporation. You didn't get that money for free. You owe it back to the company. And most of the time, in the event of a legal action or an audit by the IRS or some other higher power looking at you, they're going to want to see interest being paid on that loan. And so now you have to actually set up a contract between yourself as an individual and yourself as the CEO representative of this corporation. And you can make the contract favorable or whatever, but typically you're going to owe interest to this corporation for the loan that you took out. And so there's all these weird tax issues around a traditional corporation that makes it difficult to pull the money out unless you're willing to pay additional taxes on it. There are some other things that are problematic with a regular corporation, which is also problematic with an S corporation, and it's the ownership of real estate. So you do not want to own real estate in a corporation, period. And in the S corporation, I talked about the deemed sell when you distribute real property to a shareholder. Same thing happens in a regular corporation. If you buy real estate under that corporation to distribute it out, you're going to have the deemed sell. Now, the other thing that you're going to be having an issue with as a downside to a traditional corporation is this traditional corporation does not have long-term capital gain tax brackets. They only have ordinary corporate taxes. And under the current tax codes, it's a flat rate of 21%. So all income is taxed at 21% in a traditional corporation. And that doesn't matter if it's long-term capital gains or ordinary income. There is no differentiation in a traditional corporation. So if you've bought real estate, let's say you bought some bare ground, it increased in value, so you have a capital gain on it, and you distribute that property out of this corporation to yourself, you would have a deemed sell, and let's say it increased in value for $200,000. As an individual, that would be considered a long-term capital gain taxed at the preferential tax brackets. But in a traditional corporation, that is 100% ordinary, and so you're going to owe the flat 21% on that, even though no cash even exchanged hands. So these are kind of the problems with a corporation is your money gets locked in there unless you're willing to pay taxes, or you're able to pull it out in kind of limited areas such as rent or a few other things. But they're typically pretty limited in the amount that you can actually run through there for tax savings. So that's the biggest issue is the double taxation rules. But the best benefit is the limited liability for shareholders. There's a lot of different types of corporations. So if you're going to want to start a nonprofit, the best route is through a regular corporation. And then there's a lot of other things that you can do with corporations that the other entities we've talked about can't do. There's a lot of depth to that that we just frankly don't have the time to go into right now. But that's kind of why you would be a corporation or start a corporation, and kind of the hurdles that you're going to have to overcome in the tax code as you work through this corporation. Who do I recommend to start a corporation? Honestly, very, very few people. Normally, it's going to be something you grow into as you start to need additional money, investors. So you might start off as a single member LLC taxed as a sole proprietorship. You grow it a little bit. We elect to treat you as an S corporation. You grow it some more. You might bring in some family or friends or a partner that works for you into your S corporation. And then you grow to the point where it's like, okay, we need some large resources of funds. So this is, then you're going to start selling portions of your business. Well, prior to doing that is when you're going to make that election to revoke your S corporation status, and you're going to go become a traditional corporation. You might even change your registration to Delaware or Wyoming. Uh, the other reason why I would suggest making a corporation right off the bat would be because of the type of structure you're building. Let's say you're offering stock option benefits to executives, different things like that. And you start off with a large source of funding that might be through an SBA loan, that might be through angel investors, that might be through different structures that you have with friends and family. But you have enough refunds or funds at the beginning, and you want to incentivize people to work for you, so you offer stock options. This is very reminiscent of the dot-com eras in the 90s when we had a lot of tech companies rising with all this cool technology, and they couldn't afford to pay executives cash, so they offered them stock options in the actual business. So you have a startup that's registered as a traditional corporation right off the bat because of something like that. So that's kind of the take on a traditional corporation. Hopefully, this was beneficial for people, and you have a wonderful weekend. And we'll see you next week.